Hello, and welcome back to NatSec EmTech, where we push the discussion forward. Joining me today is Alan Cohn, Chair of the Financial Innovation and Regulation Practice at Steptoe. Alan, welcome to the show.
Thank you.
So let's start with just a general question, particularly for people who are not technically inclined. What exactly are cryptocurrencies at their core beyond just mere price speculation?
So look, the purpose of cryptocurrencies, as originally conceived, was to be able to replicate the process of engaging in a peer-to-peer transaction, just in a digital form. So if I want to buy something from you for $1, what I would do is I would take a dollar bill out of my wallet, I would hand it to you, and you would hand me the object that I've just purchased. We don't need SWIFT. We don't need the Federal Reserve. We don't need Wells Fargo to be in the middle of that transaction. We can just do that, you and I. The challenge is it's much more difficult to do that in the digital world because of two problems: scarcity and uniqueness. First, from a uniqueness perspective, if I represent to you that I am emailing you $1 and attached is a PDF, there's no guarantee that I'm not sending that PDF, that same PDF to everyone. So there's no guarantee that that's actually $1, that I've actually transferred a unique dollar to you. And the second is scarcity. I could be just kind of creating a serial number of electronic dollars and just sending them out by email. And there's really no way for anybody to know. And so for that reason, nobody does these things. And it was a conundrum, a problem that people wrestled with for a long time. Cryptocurrencies solve that problem of being able to do peer-to-peer transactions digitally.
Exactly how is this done so that we can understand what the minutiae are, as it were, in terms of understanding the process that's followed?
Right. So the innovation that came about in terms of cryptocurrencies, as opposed to previous digital currencies, which had existed, but which were centrally administered, was the idea of the blockchain and this blockchain protocol that would underpin the cryptocurrency. So we already do digital transactions today, right? If I wanted to buy something from you for $1, I could send you that dollar on Venmo. But that's Venmo maintaining a central ledger and enabling that transaction between the two of us. That's not the same as us just transacting peer to peer. So what the blockchain allows you to do is it allows you to actually do that peer-to-peer transaction of value without the intermediary. And the way that it does that is it replaces that single central ledger, like a Venmo or a SWIFT, with a distributed set of ledgers. And people call it, refer to blockchain technology sometimes as distributed ledger technology. They're talking about this element of the technology, which is that instead of having one central ledger keeper, we have many ledger keepers. And so imagine a room full of people, each holding a ledger book that is exactly the same, that records how much value each of us has. And so to transact, what I would do is I would say, everybody, can I have your attention? I want to transfer 1 unit of value. And in cryptocurrency world, the first unit of value we decided on was the unit would be the Bitcoin. I want to transfer 1 Bitcoin to Professor Donahue. Everyone would take their ledgers out and they would check a couple of things. Number one, do I have a Bitcoin in my wallet, right? In the wallet that I'm identifying that I want to send from. And then second is, have I identified your wallet, the wallet that I'm sending to? And then third, have I given my private key, essentially my password, to authorize that transaction? Once everyone has validated that, has looked at that and made sure that that's the case, then they can scratch off 1 Bitcoin from my ledger and add 1 Bitcoin to yours. So that distributed ledger function is kind of the core of the technology. But there's one last piece because there's a potential problem with that, right? Which is what's to prevent any of the ledger keepers from, instead of taking one Bitcoin, scratching it off my account and adding it to yours, and instead scratching it off my account and adding it to theirs. So all blockchains have some type of distributed, decentralized consensus mechanism for validating transactions. They go by various names. There's proof of work, proof of stake, proof of state, many others that represent different ways that nodes on the blockchain, think of the ledger keepers, look at transactions, make sure that they are valid, and bundle them together into blocks that can then be added to the previously validated blocks in a sequentially numbered chain, hence a blockchain. And so in a proof of work environment, what would happen is the blockchain protocol would create a math puzzle every 10 minutes. As blocks are bundled every 10 minutes, the protocol creates a math puzzle that is simply solved by brute force. Computers creating hashes over and over and over again until they guess the one that the protocol is thinking of. And the node that is the first to get that answer gets a reward, and it gets that reward in the form of new Bitcoin, in the case of the Bitcoin blockchain. And so this is actually the process that's referred to as mining, because you are bringing new Bitcoin into existence by doing this validation. And the idea is to disincentivize you from looking at the specifics of any transaction and deciding to disrupt one by theft, and instead incentivize you to invest, in essence, an increasing amount of compute power into the network in an effort to continue to earn these rewards, making that more valuable than the theft from any particular transaction. The other thing is, because the system is decentralized and because the nodes are distributed, once the puzzle is solved, once the blocks are validated, when it goes to be added to the chain, if there's one node that's come to a different answer, that's validated the block in a different way, then the rest of the nodes can disregard that. The next block is going to be added to the chain for which the majority of the nodes have agreed. And so in that way, a blockchain protocol is self-healing and self-protecting against either error or corruption of any node.
Okay, so you've mentioned that we have this digital ledgers are not new. Like what we think credit cards, for instance, would be a centralized digital ledger held by one particular entity, which records and provides a record of interactions or transactions that have occurred. The cryptocurrencies are different from your explanation because you duplicate those records amongst various nodes. So they're actually held by various individuals or nodes on that network, and you have a proof of work environment that then validates it. But there are other kinds of ways to validate those transactions. Can you discuss those for just a moment?
Sure. So over time, people realized that if you looked at who was winning the rewards in a proof of stake environment, the amount of rewards you were earning was directly proportional to the amount of computing power you were contributing to the network. And so, because of concerns about power generation and use, efficiency, um, there was a realization of, well, maybe we can do away with the math puzzles, and we can simply have nodes validate transactions, and we can distribute the transaction fees that we collect from people using the network in a proportional basis to how much compute power each entity is contributing to the network. And so in that instance, entities stake amounts of compute power into the network, represented by binding amounts of their cryptocurrency into the network, and then validate transactions. That proof of stake mechanism does away with the math puzzles and creates a more efficient environment. There's other ways that transactions can be validated. In some instances, not every node validates every block. Instead, the protocol selects some smaller number of nodes on a random basis to validate different blocks. Um, there's also other mechanisms by which you have nodes looking at the network, at the state of the network at a particular time, and then the state of the network as it would be after the transactions. But all of them represent the reaching of consensus among a number of nodes rather than relying on one single entity to validate the transaction.
So one of the obvious weaknesses of at least the second one that you mentioned, the proof of stake, it's the winner takes all, right? So whoever's putting the most computing power in could alter that transaction in their favor, ostensibly.
So there's always the danger that if any one entity controls 51% of the nodes on a network, then that entity could alter the transactions, create a new chain that then diverted transactions to their own benefit. And that's a risk in any distributed blockchain environment. Um, there's a couple of safeguards against that. Number one, against blockchains like Bitcoin or Ethereum, there's an incentive for many entities to participate in node validation. There are other blockchains where a foundation or another entity selects node validators and ensures that there's a balance in distribution so that no one entity controls more than 51% of the blockchain. And so that is a known vulnerability. And it tends to crop up in blockchains for which there aren't a lot of users and aren't a lot of validators. As blockchains get more traction, get more users, get more validators, more people invest more compute power into validating. There's less of an ability for any one entity to control 51%. And I should say, in terms of the distribution of the rewards, if four entities, for example, each contribute 25% of the compute power, then on whatever periodic basis it is, each will get 25% of the transaction fees that are charged. It's not in this period, this node has validated 10 blocks, this one 9, this one 8. So the one that validated 10 gets all of the transaction fees. Instead, it's distributed proportionally to the amount of compute power that you put into the network.
So we hear a lot about Bitcoin. Can you talk a little bit about the history of Bitcoin and why this is the most well known of the cryptocurrencies?
So Bitcoin is the first, it's the earliest. There's a lot of mystery surrounding it. It's still unknown who the creator or creators of Bitcoin was. Uh, a paper published under what's presumed to be a pseudonym of Satoshi Nakamoto was published in 2008, and a group of cryptographic enthusiasts began mining blocks on the Bitcoin blockchain in early 2009. Word spread basically through message boards and throughout the kind of cryptographic cipher community. And it kind of the network organically grew. At the same time, although there was a limit of 21 million Bitcoin that can ever be mined, um, the Bitcoin were each mined through this consensus validation mechanism. There was no pre-minting of Bitcoin. There was no entity that distributed at the outset. It was truly kind of a grassroots from the bottom up network that grew organically over time. As it's the oldest of the cryptocurrencies, it's also been it's been attacked. There have been attempts to hack the blockchain, the Bitcoin blockchain. There have been attempts to steal from the Bitcoin blockchain. There have been attacks on Bitcoin, well known from bank executives and others. And through all of it, Bitcoin has maintained its security. and it has continued its rise in value, even despite setbacks like early exchange hacks, um, like disagreements within the community about ways should Bitcoin upgrade itself to increase block size and transaction speed, potentially at the expense of security and stability. And so Bitcoin has really weathered all of those storms. And between the first mover advantage, its kind of grassroots origins, and its long history, it is the coin that people know the most. And it has kind of joined a group of a class of investments that are considered stores of value.
So if every time you mine, for instance, if you have a proof of work concept, you're awarded Bitcoin, how does that work if there's a 21 million limit on Bitcoin?
So basically, every 4 years, the amount of the reward halves. So what that does is it creates a deflationary system rather than um, creating a loss of value in the currency. It creates scarcity within the network, increasing the value of the coin. And so what has generally happened is we've seen an increase in value around each of these halvings, but you also see an inflection point where if you look at the people doing mining now, and really mining has moved from individuals in their basements with old computers or old computers tethered together or people using their graphics cards. Now these are largely large professional operations of huge data centers running servers with application specific chips that are optimized solely for Bitcoin mining. They require enormous investment in the hardware, in the power to operate the hardware, and in the cooling of the hardware. And so each of these halving moments kind of weeds out the weaker or the less capable of the entities, and it rewards greater and greater investment into the integrity, even though the actual physical number of Bitcoin that are being awarded is halving. And of course, Bitcoin is subdivisible down to the eighth decimal point. So halving can continue on and on and on for a number of years, number more years before all 21 million Bitcoin are mined.
How many actors are there in the Bitcoin world?
It's hard to know. A few years ago, the estimate was 12,000 nodes active on the Bitcoin blockchain. But we also know that many of the nodes are operated by large mining pools, owned and operated in different parts of the world. And so it's there's certainly not 12,000 individuals running Bitcoin, full Bitcoin nodes on their individual computers. But in terms of the number of pools, which among the larger pools is probably in the dozen to dozen and a half number, within there are entities that own portions of those, that have shares of those, that operate portions of that, and there are new mining operations that arise. In fact, there were a number that were created and expanded just in the last year as cryptocurrency regulation, the regulatory environment has really changed under the new administration.
Ostensibly, these are quite expensive. Are there state actors behind these, or are these non-state actors that are setting up this? You mentioned 12 to 18 massive data mining nodes globally.
Ostensibly, they're private actors. In some of the countries in which they operate, there's speculation as to whether there are state actors involved in the process, either financially backing entities or otherwise. But ostensibly, the pools on their face are operated by private companies, private actors.
And are those names publicly known?
They are, and a Google search will will reveal kind of the lists of the top mining pools around the world. It varies from time to time. I couldn't give it to you off the top of my head.
So, can you discuss the difference between Ethereum and Bitcoin?
So it's interesting. For a lot of the the early years when Ethereum emerged, there was a lot of debate about whether Bitcoin or Ethereum was going to quote unquote win. But it's actually easier to think about Bitcoin and Ethereum as um, complementary blockchain protocols that, if not originally aimed at different things, although partially originally aimed at different things from their inception, certainly serve different functions at this point. So the Bitcoin blockchain was programmed for security and stability. And as we talked about, um, it has been in operation since early 2009. It hasn't been hacked. Its security has stayed sound. Um, it has been relatively stable in terms of its upgrades, with a couple of notable disputes within the community. But it has ultimately ended up functioning as as a relatively secure store of value, and certainly a very secure information technology platform. Ethereum was actually programmed by a group of Bitcoin enthusiasts who loved Bitcoin and the concept of Bitcoin, but they wanted to be able to program business logic into the protocol. And while the Bitcoin blockchain, its programming language is, um, has proven itself to be pretty bulletproof, it's also very difficult to code in. And so trying to script business logic into the Bitcoin blockchain is difficult, time consuming, hard. There's only so much that you can make it do. And so Ethereum was really coded as as basically replicating the Bitcoin blockchain, but with a scripting language that was much easier to program, so that you could, in addition to being able to to store value, you could also make good on some of the other ideas um, that were kind of the genesis of Bitcoin and the blockchain, which was to be able to use as a medium of exchange and as a platform for transactions. And so Ethereum is, again, in its original form, um, based on the Bitcoin blockchain, but with an easier programming language. One of the major changes that happened in the Ethereum blockchain, and again meant as part of the improvements that have increased transaction throughput and speed, enhanced functionality, was that Ethereum transitioned from proof of work to proof of stake, making it more efficient, streamlining its transaction validation process, but also separating it from Bitcoin in terms of the reliance on proof of work as kind of the ultimate security control and stability control on the blockchain.
Can you discuss a little bit about oracles, right? The whole function of a smart contract in the Ethereum context as distinct from Bitcoin, where it's more of a transactional basis.
Yeah, and no, you can program smart contracts on the Bitcoin blockchain. It's just a lot harder. Um, but this is one of the great things about the Ethereum blockchain, is that in addition to having wallets, you can program smart contracts, basically simple if-then um, uh, transactional codes that execute upon um, upon the occurrence of a particular event. So the smart contract can either say, if, you know, if a person sends, X amount of Ethereum to this wallet, then Y event will occur. And the smart contract will issue, something else, or a wrapped version of that Ethereum, or a different token, and an NFT, something else. Um, The smart contract can also be triggered by another contract. So the execution of smart contract A can then trigger the execution of smart contract B. But the third category, and to get to the question of oracles, is that smart contracts on the Ethereum blockchain, and really on any blockchain that enables the programming of smart contracts, can be triggered by the occurrence of external events, provided that those external events are reported in some digital manner that the smart contract can read. So let's use, for example, a parabolic crop insurance policy. So beyond a certain size, below a certain size, a policy like that is really difficult to administer on a claims basis. So if you're farming, let's say, an acre of land in a remote area, um, it's difficult to, uh, to actuarially determine what would be the exact premium that I should pay. And then if the crops failed, sending an adjuster out to adjust that claim and figure it out. So instead, what you can do with the smart contract is you can say, well, we're going to create an insurance policy that you can purchase on your phone. It will cost X amount of Ether. And that insurance policy is actually a smart contract. And it says that if there are drought conditions for, let's say, 28 continuous days in a particular season for that acre, then the smart contract will pay out a fixed amount, 100 Ether, the US dollar stablecoin, something of that amount. How will the smart contract know that there were 28 days of drought? Instead of having a human having to determine that, you can specify that 28 days of drought as referenced by this application at this web address or this application via this API. And the contract can monitor that electronic source, and the contract can be triggered by the event without the intervention of a human at any point in that chain.
So at one level, when Bitcoin, the Bitcoin white paper, this famous white paper was put out, the idea was that Bitcoin would have no intermediaries, right? That this would be kind of a self-executing system. But now we've discussed miners, validators, developers, we have exchanges, we have custodians, we have all of these other accoutrements of the system. Uh, which of these actors matter the most? Are they expendable? Are we just on our way to an eventual kind of manifestation of that Bitcoin white paper? Help us understand what all these different functions mean in terms of the actual operation of cryptocurrencies.
Well, I think we're at, I would say an inflection point, but I think a kind of a multifaceted inflection point, which we've been reaching over the last few years, and which I think is now coming to a head with the Trump administration being very pro crypto, and the Congress responding by passing legislation, and the administration then implementing, issuing guidance and implementing regulations that then put that legislation into place. And the tension really comes from, um, it was always intended that there would be miners, the node operators, because of course that's how the system works. And they were always intended that there would be users, right? People who used the cryptocurrency for different purposes. That then suggests that there would be peer-to-peer transactions, certainly between users, people maybe purchasing goods and services from each other, but potentially also from vendors who would accept cryptocurrency for payment. However, taking that concept beyond that point, you then get to the question of the current financial system works because of, as you noted, a series of intermediaries that make it easier to use the technology that's in play, or even just the elements of that financial system. So if you want to have people who can transact with cryptocurrency, you can download the Bitcoin node software, and you can create your own self-hosted wallet. But it's difficult, and you have to have some, familiarity um, with using computers outside of the graphical interface of a Windows or an Apple operating system. Um, Much easier if a company codes a wallet and you can download it from the App Store. But even if that wallet still is self-custodial in the sense that you hold the cryptocurrency, not the wallet company, you've now introduced another entity into the mix, a developer of a tool to use. Um, you and I can exchange Bitcoin with each other. We can engage in peer-to-peer transactions, but let's say I want to purchase Ether with my Bitcoin and you don't have any. Well, it's harder for me now to figure out, how do I get that Ether? I can put an ad in the paper and see if somebody wants to exchange with me. And that actually did happen at the beginning of the early on in cryptocurrency and services, like local Bitcoins and others sprung up. Um, and they enabled people to engage in peer-to-peer transactions with people who they didn't know, but who had cryptocurrency that they didn't want, or that they wanted to exchange for other cryptocurrency. Um, that ran into a number of anti-money laundering and other regulations, which we can talk about in a moment. But the idea became that those services then gave way to actual formal exchanges, places, places, computer platforms, program on the internet where you could go and you could create a quote unquote wallet, which was really an account. And then there were a whole number of other users who had other types of cryptocurrencies that they might want to exchange. And the exchange operated an order book, basically, a matching engine that would match one person with another in order to make that transaction. And then the exchange would take a small fee for facilitating that. So now all of a sudden, in the service of making the technology easier to use and enabling more people to use it, we've introduced another party. And in this instance, we've introduced an intermediary, because of course, the way that you make sure that that you get paid as an intermediary, the easiest way, is for you to be to control both sides of the transaction and have the transaction flow through an engine that automatically takes a fee off. And so when you use a centralized exchange, you basically have an account with the exchange, and you are trading with other people who have accounts, and that's all being settled off chain and all within the exchange's omnibus wallet. So it's the exchange's wallet, and the exchange then, if you're sending off the exchange or the exchange is to balance liquidity, those transactions come from the exchange's omnibus wallet. So now you've introduced an intermediary into the system. But by introducing that intermediary, you've now brought a whole bigger number of people into the system. Now, with smart contracts and business automation and all sorts of functionality, and the prospect that this technology is more efficient in many ways for things like remittances or interbank transfers or things of that nature than existing um, financial technology. Now you have the idea that you might bring this technology into the financial system proper, which would then increase even more exponentially the number of people using it, but also brings in a whole additional number of participants and intermediaries. So there's something of a crossroads of whether the technology continues to develop kind of, in a sense, independent of or parallel to the traditional financial institutions, and represents this ability for peer-to-peer transactions of various types without the intermediaries of the traditional financial system, while at the same time, the traditional financial system is adopting a lot of the innovations that are coming out of that world. And in a sense, there is much more success in the innovation community outside the traditional financial services industry innovating with the technology than the financial services industry itself. But then, as soon as that technology has proven itself, the financial services industry wants to try to figure out ways to then import it into the traditional financial services industry. So we are at this strange moment where you have this tension pulling in a number of different directions between the original vision and the idea of mass adoption and inclusion in the traditional financial services industry.
Great. So, exciting. Let's talk about law. Also super exciting. So I think about the law in this area as three buckets. right? The first is the whole anti-money laundering, sanctions, and illicit finance regime. The second is kind of the securities, commodities, and market structure type rules and laws and statutory provisions. And then the third is kind of the regulatory environment, enforcement versus kind of rulemaking and what that looks like. So if we bite off the first piece of that, the anti-money laundering, the sanctions, illicit finance, when does a crypto business essentially become a money services business under FinCEN rules? And what are the legal implications of that?
So
And we may need to go back to the Bank Secrecy Act and
yeah.
kind of lay out the very basic structures of that.
So we'll start with just the Bank Secrecy Act, and we won't go too deeply, but the Bank Secrecy Act is the primary U.S. law aimed at combating money laundering, or so anti-money laundering, or what we'll refer to as AML. And the Bank Secrecy Act regulates financial institutions of various types. And the Financial Crimes Enforcement Network, or FinCEN, which is an agency of the Treasury Department, enforces the Bank Secrecy Act in most instances. So they promulgate regulations. There are other U.S. regulatory agencies that have AML enforcement authority. The Commodity Futures Trading Commission is a good example. But the rules are again, the idea is tailored. Categories of financial institutions have rule sets under the Bank Secrecy Act. So one type of financial institution is a money services business. And that's a person, meaning a person or an entity, wherever they're located, that's doing business, whether on a regular basis or not, wholly or in part within the United States in one or more specifically enumerated capacities. And one of those capacities is money transmission. And money transmission is when a person, again, a person or an entity, is engaged in the transfer of funds, meaning the acceptance of currency or funds or other value that substitutes for currency from one person, and the transmission of currency, funds, or other value that substitutes for currency to another location or person by any means. So if you think about the various intermediaries in the cryptocurrency ecosystem, many of those intermediaries are engaging in money transmission if they are taking custody or control of cryptocurrency, and then they are transmitting it from one place to another, or from one person to another. And so in many ways, the rules relating to anti-money laundering are some of the clearest in the cryptocurrency industry, at least when it comes to centralized entities. So if you are engaged in money transmission, if you're a money services business, then you are required to register with FinCEN, which is a pretty straightforward process and really meant to give FinCEN visibility on who is out there conducting money services business. Adopting, implementing, and maintaining an effective and written AML compliance program that is commensurate with the risks posed by the business activity. So they're not hard and fast rules about if you have cryptocurrency, handle cryptocurrency, you must do this, but you are required to tailor the program to the risks of the activity that you are engaging in. You have to have policies and procedures and internal controls to monitor transactions and file suspicious activity reports and other types of reports with FinCEN, which gives FinCEN and the rest of U.S. law enforcement community a view into the monetary transactions that are going on, either above a certain level or for which a financial institution has suspicion about the transaction. And then you have to do your own independent review of your AML program. So hire a third-party vendor in on a periodic basis to review the policy. And then FinCEN can come in and audit any money services business on a periodic basis. And so if you are a centralized entity, if you're an exchange, or if you're an administrator of a cryptocurrency, meaning you can issue it and then you can withdraw it, then under FinCEN guidance, you are a money transmitter, you are a money services business, and you are subject to these rules. And FinCEN has put out a set of guidance starting back in congressional testimony in 2012, the essence of which was cryptocurrency is meant to be like currency. So we have rules about how you handle currency, follow those rules, to a set of guidance in 2013, 2014, that set out the frame of exchangers and administrators versus users, who are generally not considered money services businesses or money transmitters. A very well-known enforcement action in 2015 against Ripple, where it kind of put a lot of that guidance into action and showed that that FinCEN would take an enforcement stance where necessary to enforce these rules. And then
Which created the ripple effect.
yeah, so to speak. A consolidated set of guidance in 2019, which kind of rolled up all the previous guidance and added some other elements. And really that stretch from 2012 to 2019, the guidance was pretty clear. It was cumulative. There were difficulties in implementing parts of it, and the fit wasn't perfect, but it provided the industry with some left and right boundaries and some guidance on how to operate. Since 2019, questions about decentralized finance, decentralized exchanges, and where the technology truly is beginning to operate without intermediaries, that's been a much harder area to regulate. And to date, there still aren't clear rules about exactly how that is all supposed to work. But FinCEN, for the most part, in the earlier days of cryptocurrency, set out a set of rules about anti-money laundering that were relatively clear.
Alan, thank you so much for discussing today exactly what cryptocurrencies are, how they operate, and how we should be thinking about them going forward. We look forward to welcoming you back soon.
Thanks so much for having me on.